Okay, so are you ready to kind of decode the language of the markets? We're diving into the fascinating world of technical analysis today, using the classic technical analysis of the financial markets by John J. Murphy as our guide. This book is practically legendary, it's kind of like the Wall Street equivalent of finding like a treasure map.
And just like a good treasure map, this book can lead you to some pretty valuable insights, even though it was first published back in 1985 and, focusing on futures markets. It's been updated over the years to cover stocks, too.
Yeah.
It's a testament to how well these principles hold up no matter what's happening in the markets.
And speaking of credibility, our author, John J. Murphy, he isn't just some guy with a computer. He was a technical analyst for CNBC for 7 years, meaning, he was in the trenches using these techniques day in and day out. So no pressure on us to get this right.
Well, the good news is that the book lays out a very clear framework for, understanding technical analysis. It's all about identifying those recurring patterns and signals within the market's movements, kind of like a detective looking for clues to solve a case.
That's a great analogy because it's not about random guesses, right? So let's talk about these clues. The book starts with 3 core principles. The first one is a bit of a head-scratcher. Market action discounts everything. Honestly, it sounds a bit like something you see on a motivational poster.
Yeah. It might sound a bit cryptic, but it's actually pretty profound when you really think about it. Think of it this way. The price of an asset at any given moment reflects all available information, whether it's news, earnings reports, whispers about a new product launch, everything. It's all baked into the price.
So even if I think I've uncovered some hidden gem of information, the market likely already knows about it, and it's baked into the price.
Exactly. And that's where technical analysis comes in. It helps you read between the lines of those price movements and understand what the market is really telling you. It's like deciphering a secret code that reveals the collective wisdom or fear or greed of all market participants.
Okay, that makes sense. Now, the other 2 principles seem a bit more straightforward. Prices move in trends, and history repeats itself. Are we talking about those charts with the lines going up and down and sideways?
You got it. Imagine like a snowball rolling down a hill. It's going to keep rolling in that direction until something stops it, right? Markets behave similarly. They have momentum, creating trends that technical analysts aim to identify and ideally get ahead of.
So it's all about spotting which direction that snowball is rolling before everyone else figures it out. But the million-dollar question is, how do you actually do that?
Well, the book dives into a variety of tools and techniques, starting with different types of charts. You've got your bar charts, your line charts.
You know what? You're right. We should probably talk about those charts. But honestly, our listeners are already pretty savvy when it comes to the basics. They know their bar charts from their candlesticks. Let's jump ahead a bit, shall we?
Sounds good to me. We can skip the charts 101 and get into the good stuff.
Perfect. Now, one thing that caught my eye is how the book emphasizes the technical analysis isn't just about reading charts. It's about understanding the forces behind those price movements. And sometimes those forces seem to defy logic.
Absolutely. Remember that principle, market action discounts everything. Well, sometimes, a company will have fantastic earnings, but their stock price will drop, or vice versa. It's those moments where technical analysis can be incredibly insightful.
So it's not just about the numbers, it's about sentiment, psychology, and perhaps even a bit of intuition.
Precisely, and that's what makes it both challenging and incredibly rewarding.
Now, the book dives deep into various aspects of technical analysis, but let's just focus on the concept of trends for now. Can you break down what a trend is and why it's so crucial for anyone looking to make sense of the markets?
Yeah, so think of a trend as the market's direction. Is it heading upwards, downwards, or just kind of meandering sideways? Most technical tools are designed to be trend following, meaning they work best in markets with a clear direction, like our snowball example.
So trying to use a trend-following strategy in a sideways market would be like trying to steer a snowball that's stuck in a rut.
Exactly. It's not going to get you very far. That's why identifying the trend is step 1, and it's where those charts become really important.
Right. The book mentions 3 trend classifications: major, intermediate, and near term. Are we talking about how long these trends last?
You got it. Major trends are like the big waves in the ocean, lasting for a year or more, while intermediate trends are like smaller waves within those larger ones, maybe lasting a few weeks or months. And then you have your near-term trends, which are more like ripples. They come and go quickly.
I'm noticing a recurring theme here. The number 3. We've got 3 core principles, 3 trend classifications.
It's true. The number 3 pops up a lot in technical analysis. For instance, there's the fan principle, which uses 3 trend lines to help identify potential trend reversals.
Okay, let's break down this fan principle. Are we talking about drawing lines on a chart and seeing where they intersect?
You're on the right track. Imagine drawing a trend line connecting a series of lows in an uptrend. Now, draw 2 more trend lines with increasingly steeper angles from that same starting point.
So like a fan opening up.
Exactly. The theory is that if the price breaks the first trend line, it's a warning sign. A break of the second trend line is a stronger warning, but if it breaks that third steepest trend line, it often signals a significant trend reversal.
Wow, it's fascinating how these visual patterns can provide insights into potential market shifts.
And speaking of patterns, there's one thing that always intimidated me, those trend lines. How do you even know where to draw them? Is it an exact science or is it a bit more of an art form? Well, it's a bit of both, to be honest. You're looking for points where the price has clearly reversed direction, connecting those highs or lows to form your trend line. But the key is that a trend line isn't truly valid unless it's touched by the price multiple times.
So it's like testing the boundaries. If the price keeps bouncing off that line, it's a sign that the trend is holding strong.
Exactly. And the angle of the trend line can also tell you a lot about the strength of the trend. You'll often hear chartists talk about a 45-degree angle being the sweet spot for an uptrend line.
Why 45 degrees? What's so special about that angle?
It often represents a sustainable, healthy uptrend. A steeper trend line, like something approaching 60 or 70 degrees, often indicates a rapid, almost frantic move that might not be sustainable. It's like a sprinter going full speed. They can't keep that pace up forever.
So a steeper trend line could be a sign that the market is getting ahead of itself.
Precisely. It's often followed by a period of consolidation or even a reversal. On the other hand, a flatter trend line, maybe something closer to 30 degrees, might suggest a more stable, sustainable uptrend.
This is starting to make so much more sense. Just by looking at the angle of those lines, you can glean valuable insights into the underlying strength of the trend.
That's the power of technical analysis.
Now, the book also mentions something called a channel line. Is this another line we draw on the chart?
You got it. A channel line is drawn parallel to the basic trend line. So if you have an uptrend line connecting a series of lows, the channel line would be drawn above the price action, connecting a series of highs.
So we're creating a channel that the price is essentially bouncing between.
Exactly. This channel can be incredibly useful because prices often respect those boundaries. They might bounce between the trend line and the channel line multiple times before eventually breaking out.
That's amazing. It's like having a roadmap for potential price moves. But how do we know where those bounces might occur within the channel?
That's where things get really interesting. Remember those percentage retracements we talked about earlier? They can be incredibly useful for pinpointing potential support and resistance levels within a trend channel.
Okay, you've definitely piqued my curiosity now. Let's talk about these percentage retracements. So percentage retracements, it sounds like something out of a geometry textbook. Is this where things start to get really math heavy?
Don't worry, you won't need your calculator for this one. Percentage retracements are actually pretty intuitive. After a significant price move, either up or down, the market often pauses to catch its breath right on men.
Makes sense. It's like that saying, what goes up must come down. Though, I guess in trading, it's more like what goes up often comes down a bit before maybe going up some more.
You got it. And those temporary pullbacks are what we're talking about with retracements. The idea is that these retracements often happen in predictable percentages of the original move.
Okay, so give me an example. Let's say a stock goes on a tear and rallies from like $50 to $100. What would a retracement look like in that scenario?
Well, a 50% retracement, which is the most common, would bring the price back down to $75. That's halfway back to the starting point of the move.
So it's like the market is hitting the rewind button, but only part way.
Exactly. Another common retracement level is the 38.2% retracement, which in this case would be around $80.80.
Okay, so let me see if I've got this straight. These retracement levels, like 50% and 38.2%, become potential support or resistance levels. So if that stock that rallied to $100 starts to pull back, traders will be watching those levels closely.
Absolutely. If the price pulls back to that $75 level, the 50% retracement, and starts to bounce back up, it reinforces the idea that the uptrend is still intact. Traders might see that as a buying opportunity.
So it's almost like getting a second chance to hop on the trend if you missed the initial move.
That's a great way to think about it. Of course, it's not foolproof, but understanding retracements can definitely help you time your entries and exits more effectively.
Now, earlier we were talking about trend lines, and you mentioned that percentage retracements can help us pinpoint potential support and resistance levels within a trend channel. Can you, connect the dots for me on that?
Absolutely. Imagine you've drawn your trend line and your channel line on a chart. Now visualize those percentage retracement levels: 38.2%, 50%, 61.8% running horizontally across the chart.
So you're creating a grid of sorts with these intersecting lines.
Precisely. And where those horizontal retracement lines intersect with your upward sloping trend line or your downward sloping channel line, those points often become significant support or resistance levels.
Okay, my mind is officially blown. So we're combining these trend lines with percentage retracements to pinpoint those key areas where the price might reverse, or at least pause.
You got it. It's like having a treasure map with X's marking the spots where you're most likely to find buried treasure.
This is why I love technical analysis. It's like a giant puzzle, and we're slowly piecing it together. Now, the book also mentions price gaps, which sound intriguing. What exactly are those?
Imagine you're looking at a stock chart and you see this sudden jump in price, like overnight. Let's say the stock closed at $20 on Tuesday. And when you check the chart on Wednesday morning, it's opened at $22 with no trading activity in between. That, my friend, is a price gap.
So it's literally a gap on the chart, like the market took a sudden leap across empty space.
Exactly. These gaps happen for various reasons: positive news announcements after the market closes, earnings surprises, even just a surge in buying or selling pressure that creates this temporary imbalance.
Okay, that makes sense. But the question is, how do we make sense of these gaps? Do they even mean anything?
They absolutely can. The book talks about three main types of gaps: breakaway gaps, runaway gaps, sometimes called measuring gaps, and exhaustion gaps.
Do all gaps get filled? I swear I've heard that somewhere, like it's a rule of the market.
It's a common saying, but it's not always the case. Some gaps act like magnets, drawing the price back to fill them, while others remain open for a long, long time.
So how do we tell which gaps are which? What makes each type unique?
Well, breakaway gaps usually happen at the beginning of a significant price move. Imagine a stock that's been stuck in a trading range for weeks, and then suddenly it gaps up on heavy volume. That's often a sign that a new uptrend is starting, and that gap might not get filled for quite a while.
So it's like the market is saying, okay, enough of this sideways action, we're moving on.
Exactly. Runaway gaps, on the other hand, often happen during a strong trend. It's like the market is so enthusiastic about the move that it can't even wait for the next trading day to continue. They often signal that the trend has a lot more room to run.
So it's like adding fuel to the fire. What about exhaustion gaps? Those sound ominous.
They can be. Exhaustion gaps often appear toward the end of a move, signaling that the momentum is fading.
So imagine a stock has been rallying for days, maybe even weeks, and then it gaps up one last time on lighter volume than usual. That could be a sign that the buyers are exhausted and a reversal might be near.
You've got it. It's like a final burst of energy before the party's over. Now, remember that island reversal pattern we talked about earlier, with the up gap followed by a down gap? That's a classic example of an exhaustion gap signaling a potential top.
Okay, you're really making me want to go back and study all these different gap types. It's like learning a whole new language to decipher the market's messages.
Yeah.
Speaking of patterns, let's talk about the ones that make even seasoned traders a little nervous. The major reversal patterns.
Ah, yes. The patterns that separate the bulls from the bears, the dreamers from the realists. They can be dramatic, they can be unpredictable, and they can certainly make your heart skip a beat if you're on the wrong side of the trade.
That's a great way to put it. It's like the market throws these curveballs to keep us on our toes. So before we dive into specific patterns, are there any common threads that tie all these reversal patterns together?
Absolutely. Remember that principle: market action discounts everything. Well, these patterns are visual representations of that principle in action. They reveal shifts in sentiment, battles between buyers and sellers, and ultimately the never-ending cycle of market psychology.
It's like the market is having an internal dialogue, and these patterns are the words being spoken.
I like that analogy. And just like learning to read body language or facial expressions, understanding these patterns can give you a deeper understanding of what the market might do next.
Okay, so let's decode some of these market messages, shall we? All right, let's talk reversal patterns. The book mentions that topping patterns, those that signal a potential shift from an uptrend to a downtrend, are typically larger in size than bottoming patterns. Is there a reason for that?
It's a fascinating observation, isn't it?
Yeah.
It's like the market takes its time building up to a peak, almost as if it's reluctant to, let go of a strong uptrend. Think about how greed and euphoria can sometimes take hold during those rallies. People are hesitant to believe the good times will ever end.
Right. But eventually, the reality sets in.
Exactly. And that's often when those topping patterns emerge, reflecting a shift in sentiment as more and more participants decide to take profits or get out while the getting is good.
Okay, that makes sense. So let's delve into a specific pattern that even people who've never traded have probably heard of, the head and shoulders pattern.
It's the celebrity of reversal patterns.
Yeah.
And the name is quite literal. You can actually see this pattern play out on a chart, almost like a market-made sketch.
So walk me through it. How does this head and shoulders pattern actually form, and what signal does it send?
Okay. Imagine a stock that's been in an uptrend. It makes a new high, that's the left shoulder, pulls back slightly, then rallies to an even higher high, that's the head. Now here's where it gets interesting. It pulls back again, but this time it struggles to make a new high, forming a lower peak, the right shoulder.
So it's like the market is trying to regain its upward momentum, but just can't quite muster the strength.
Exactly. The bulls are getting tired, and the bears are starting to sense an opportunity. Now, connect the lows between those peaks, the left shoulder, head, and right shoulder, and you've got yourself a neckline.
The neckline. So that's the line in the sand, so to speak.
Precisely. If the price breaks down below that neckline with conviction, often accompanied by a surge in volume, it's a strong signal that the trend has reversed and a downtrend might be in store.
So the head and shoulders pattern, it's all about that break below the neckline.
That's the confirmation signal. Now, there's also a handy measuring technique that traders use to kind of estimate a potential price target once that neckline is broken.
Ooh, tell me more.
Okay. You simply measure the distance between the top of the head and the neckline, and then project that same distance downwards from the breakout point. It's not always precise, but it can give you an idea of how far the price might fall.
That's incredibly helpful. It's like having a roadmap for a potential downtrend.
Exactly. And of course, what goes up can also go down, which is where the inverse head and shoulders pattern comes in. As you might guess, it's the bullish counterpart, signaling a potential reversal of a downtrend.
So instead of peaks forming a head and shoulders, it's valleys or troughs forming an upside down head and shoulders.
You got it. And all those principles we discussed, the neckline, the volume confirmation, the measuring technique, they all apply, just in reverse.
This is fascinating. The market really does speak its own language, doesn't it? Now, are there other reversal patterns we should have on our radar?
Absolutely. Triple tops and bottoms are fairly common. Imagine the market testing the same resistance level 3 times, almost like it's hitting a ceiling, but failing to break through each time. That's a triple top, and it often signals a reversal.
It's like the market is saying, okay, I've tried this 3 times, and it's not working time to change direction.
Precisely. And as you might guess, a triple bottom is the opposite. The price finds support at the same level 3 times before potentially reversing to the upside.
Okay, those seem fairly straightforward. What about those double tops and bottoms we often hear about?
Double tops and bottoms can be a bit trickier because they're sometimes misidentified. Here's the thing. A true double top isn't just when the price touches the same level twice. It's all about what happens after that second touch.
Okay, so it's not just about the 2 peaks, it's about what happens next.
Exactly. For a double top to be confirmed, the price needs to break down below the previous low point, often called the reaction low, between those 2 peaks. That break below the reaction low is what confirms the pattern and signals a potential trend reversal.
So it's like the market is testing that previous low as a support level, and when it fails to hold, that's when the real selling pressure kicks in.
You got it. And of course, volume plays a key role here as well. A break below the reaction low on heavy volume is a much stronger signal than a weak low volume break.
So it's like the market is shouting its intentions instead of just whispering them.
Precisely.
Yeah.
Now, double bottoms work the same way, just in reverse. You're looking for a break above the reaction high, confirming a potential shift from a downtrend to an uptrend.
This has been an incredible journey through the world of technical analysis. We've covered a lot of ground, from those foundational principles to the nuances of trend lines, retracements, and even those sometimes elusive reversal patterns.
It's been my pleasure. And remember, even though we've learned a lot today, there's always more to explore. The market is constantly evolving, and that's what makes it so fascinating.
Well said. As we wrap up our deep dive into technical analysis, what's one key takeaway you would leave our listener with?
Remember, technical analysis is ultimately about understanding the human element of the market. Charts, patterns, indicators, they're all just tools to help us decipher the emotions, the psychology, the hopes and fears that drive price movements.
It's a powerful reminder that behind all those numbers and lines are real people making decisions, sometimes rational, sometimes not, based on their own unique perspectives and experiences.
Exactly. The more you understand that human element, the better equipped you'll be to navigate the fascinating, sometimes frustrating, and always unpredictable world of the financial markets.
And with that thought-provoking insight, we've reached the end of our technical analysis adventure. It's been an absolute pleasure exploring this topic with you. Until next time, remember, keep those charts handy and never stop questioning what the market is trying to tell you.